If you run a business through a company in Australia, you've probably heard of something called Div7A. It's one of those words that your accountant brings out and tries to scare the crap out of you with. Now, I understand that Div7A, if used incorrectly, can put you into a bit of trouble. However, no one ever talks about the potential benefit of how to utilize Div7A in the right way. And I'm talking about building wealth. Now, most accountants will say, if you draw money out of your business, then this is bad because then you owe that money back to the business and the ATO are going to charge interest and basically tax you in several different ways. Now, I agree. If you take out money out of the business and you start buying Ferraris or you start buying Rolexes and you start buying trips overseas, then yes, it's probably going to cause you some issues. However, if you buy those for the purposes of building wealth, building brand, building something more than just personal use, then you can actually use it strategically, right? Div7A, in a general sense, is a loan owed back to the company from you, right? So you personally taken out. Let's just say you took out $500,000 of actual cash from the business that wasn't a dividend or wasn't a wage. Now you then go and use that money however you like. Now, what I suggest is that when you do that, do it in a way that will actually benefit you. I'm sick of accountants saying that it's bad and it shouldn't be done. If it makes sense, do it. And what I mean by that is sometimes that you may have an opportunity such as a property or let's say buying assets to build up your brand. And if you have that opportunity and you can strategize with your accountant on how to make it work so that you get the gain out of that asset over, let's just say, a 7-year period and pay back your loan, then this may work for you. That cash that you're extracting has been basically taxed at the company tax rate. If you're able to extract that cash, use it to purchase, let's say, an investment property, that investment property then goes up a couple of $100,000, is that then better than paying the interest and the tax associated to that Div7A loan? Do the calculations, and if it's a yes, then Div7A loans aren't as bad as you think. Now, again, I'm going to say this again. You got to control what you purchase, and it's all about making sure that there's an ability to repay that loan and that there's some sort of benefit, capital appreciation, building yourself up, making sure that it's building the business or your personal wealth. Because if you can do that, then Div7A, it's basically a loan from yourself that hasn't been fully taxed and you're getting the major benefit out of every single dollar.